Welcome to the Deep Dive. Today, we're really going deep on the 2007-2008 financial crisis. It really changed everything, didn't it?
It absolutely did. A fundamental shift. We'll be looking at this using a couple of key sources. One from Norges Bank, experiences with the financial crisis, and the big one, the Financial Crisis Inquiry Report from GovInfo.
Right. And our mission here isn't just to list events. We want to dig into how it happened, the mechanics behind it all.
Exactly. What were the crucial moments? What really drove it? And what are the impacts we're still seeing today? We'll try to cut through the noise and focus on what you really need to know.
Okay, so where do we start? The housing bubble seems like the obvious place.
Definitely the epicenter. The sources lay out this just extraordinary rise in home prices.
Yeah, I saw some figures. Sacramento prices, what was it, 2.5 times higher in 5 years?
Insane, right. And it wasn't just one or two spots. Bakersfield, Miami, Key West, similar stories. Over 110 metro areas saw prices double. Think Phoenix, LA, Baltimore.
Wow. And the national average peaked at $227,100 back in early 2006.
Which is pretty high, especially when you consider what else was going on. Wages were pretty stagnant for a lot of people.
But borrowing was up. And spending.
Yeah, borrowing and consumption were increasing. And there was this really strong belief, almost an article of faith, that housing prices could only go up.
The classic safe as houses idea, but on steroids.
Totally. And because of that belief and historically low default rates, people weren't too worried about the growing debt. It created this environment where, well, lending standards started to slip. A lot.
Okay, so it wasn't just the subprime market. This affected prime mortgages, too.
It did. The sources show that underwriting standards weakened across the board. You saw these combined loan-to-value ratios climbing.
Meaning people were borrowing more against the house's value, maybe using second mortgages for the down payment.
Exactly. And debt-to-income ratios were rising, too. Plus, a lot more loans were going to properties that weren't even the borrower's main home. Investment properties, second homes.
So the focus shifted. Less about, can this person actually pay this back? And more about just getting the loan out the door.
That seems to be a big part of it. And you saw the products themselves get riskier. Option ARMs, for instance.
Okay, what are those exactly?
Adjustable rate mortgages, where borrowers could choose how much to pay each month, sometimes even less than the interest owed.
So the loan balance could actually go up.
Precisely. They went from maybe 2% of mortgages in 2003 to 9% by 2006. And negatively amortizing ARMs, where the balance definitely grew for a time, also exploded.
Any specific examples jump out?
WAMU Washington Mutual is a stark one. In 2003, maybe 2% of their new mortgages were these types. By 2007, 82%.
82%? That's staggering. The vast majority of their new business was potentially pushing borrowers deeper into debt.
It's hard to wrap your head around. And then you had those piggyback loans you mentioned, the second mortgage, to cover the down payment.
Right, making it easier to buy with little or no money down, but riskier.
Much riskier. The data's pretty clear. By September 2005, if you had a piggyback loan, you were 4 times more likely to be seriously delinquent than someone with just one mortgage.
4 times. Did the lenders not see this?
Well, some did. The sources mention New Century Financial, for example. They got internal warnings about these very risks.
Then what did they do?
They increased these loans from 9% of their business in 2003 to 35% by the end of 2005.
Wow. It really feels like the warning signs were just ignored or maybe overridden.
It certainly looks that way. And all these increasingly shaky loans, well, they became the raw ingredients for the next stage. Securitization.
Okay, so bundling these loans together into mortgage-backed securities?
MBS.
Exactly.
Yep.
Taking thousands of individual mortgages, packaging them up, and selling slices of that package to investors. The problem was these products became incredibly complex.
How so?
Just the structure of them, layers upon layers. It made it really hard for investors to figure out the true risk hiding inside. And crucially, when borrowers started having trouble paying, you couldn't easily modify the loans. Because they were chopped up and spread across all these different securities.
Precisely. It was like trying to renegotiate 1,000 tiny pieces of a contract scattered all over the world. Almost impossible. A huge vulnerability.
And this is where the credit rating agencies step in, right? Moody's, S&P, Fitch. They were supposed to assess the risk.
They were the gatekeepers. Their ratings, AAA, AA, etc., were essential for selling these securities, and it became a very lucrative business for them.
Lucrative.
Their revenue from rating these kinds of financial instruments, it more than quadrupled between 2000 and 2007. Big money.
Quadrupled. Okay. And were they rating these mortgage products accurately?
Well, that's the million-dollar question, isn't it? Or maybe the trillion-dollar question. Look at this. Between 2000 and 2007, Moody's rated nearly 45,000 mortgage-related securities as AAA. The highest rating? Supposedly super safe.
45,000. How does that compare to, say, regular companies?
During that same period, Moody's only gave a AAA rating to 6 private sector companies in total.
6 versus 45,000. And that just doesn't sound right. How could so many mortgage products be considered as safe as the most stable corporations?
It raises huge questions. It suggests the models they were using were fundamentally flawed. They just didn't properly account for those declining lending standards we talked about.
Or the possibility that house prices might actually fall, like everywhere at once.
Exactly. That was the big one. Their models basically assumed a nationwide housing downturn of this scale couldn't happen. Moody's even stated in 2005 they didn't think there was a national housing bubble.
A colossal blind spot. But were there other issues? Conflicts of interest, maybe?
Oh, definitely. The agencies were paid by the very investment banks, creating and selling the securities they were rating.
So the seller's paying the referee. That sounds problematic.
It created a huge incentive to give favorable ratings. You even had rating shopping, where banks would take their new security to different agencies to see who would give them the best rating.
Unbelievable. Okay, so we have risky loans bundled into complex MBS, stamped with questionable AAA ratings. Did it get even more complex?
It did. Enter the collateralized debt obligation, or CDO.
Right. These often took slices of those MBS, especially the riskier slices, and repackaged them.
Precisely. Bundling the bundles, often centered on housing debt. Bear Stearns, for instance, had 2 hedge funds with $18 billion invested by late 2006, half of it in securities from these housing CDOs.
$18 billion in just 2 funds.
And the manager of those funds, he was handling another $18 billion in similar mortgage CDOs for other clients, just a massive concentration of risk.
And then came synthetic CDOs. What were those?
Even more abstract. Investment banks like Goldman Sachs created these. Think of the Abacus 2004 one deal, $2 billion. These weren't directly backed by mortgages themselves, but were essentially bets, like insurance contracts, on the performance of other mortgage securities or CDOs.
So you didn't even need to own the underlying risky stuff to bet on it, or against it.
Exactly. It created this incredibly complex, interwoven web. If one part started to fail, say, subprime mortgages, the losses could cascade through MBS, then CDOs, then synthetic CDOs, hitting institutions all over the system.
Because everyone was connected through these instruments.
Right. Losses became concentrated in these systemically important institutions, the big banks, the investment houses, the ones whose failure could threaten the whole economy.
Which naturally leads to the question of regulation. Was anyone watching this whole house of cards being built?
Well, that's a huge part of the story. The sources really emphasize deregulation and maybe a lack of effective oversight.
How so?
For one thing, the big Wall Street investment banks operated with way more leverage than traditional banks.
Meaning more debt relative to their own capital.
Much more. They faced less strict rules on capital requirements, and then you had the rise of the shadow banking system.
Things like money market funds, commercial paper.
Exactly. Entities doing bank-like things, lending, borrowing, but outside the traditional regulatory net. But they were deeply connected to the main banking system, so if they got into trouble...
It could spill over. Got it. What about specific regulations?
Alan Greenspan, then Fed chair, was a major advocate for deregulating the derivatives market, specifically the over-the-counter OTC market, where things like those synthetic CDOs traded.
And the old Glass-Steagall Act, the one separating commercial and investment banking.
Its restrictions have been significantly weakened over the years. Some argue, like a former Citigroup co-CEO quoted in the report, that keeping those walls up might have actually made a system-wide collapse less likely.
So innovation was outpacing regulation.
It seems that way. And there were real challenges supervising parts of the system, like the subprime lending arms of big bank holding companies.
The Fed could have done more there.
They had the authority. But the report suggests they held back on really aggressive supervision, even as worries grew. There was talk of a pilot program back in 2000 to look into lenders like Citi Financial, but it's not clear if it really went anywhere.
And didn't another regulator limit states' ability to act?
Right, the OCC, Office of the Comptroller of the Currency. In 2004, they basically preempted state laws trying to tackle predatory lending by national banks.
So you have this explosion of risk, complex products, interconnectedness, And the rules and oversight weren't really keeping up.
That's the picture the sources paint, and then you layer in the incentives.
Ah, compensation. How did that play into it?
Well, the investment banks were typically paying out around half their revenues as compensation.
Half. That seems high.
It was standard practice. Goldman Sachs, 44-49% between 2005-2008. Morgan Stanley, 46-59%. And get this, Merrill Lynch paid out 141% of revenue in 2007.
Wait, 141%. More than they brought in, even though they were losing money hand over fist that year.
That's what the report says. A year of dramatic losses and payouts exceeded revenue. As firms grew and profits soared before the crash, executive pay went through the roof.
You can see how that might encourage chasing short-term profits and taking huge risks, right? Massive upside if things go well.
And maybe less personal downside if they blow up. The incentive structure seems skewed towards risk-taking.
Okay, we also need to talk about Fannie Mae and Freddie Mac. The GSEs.
Absolutely central to the U.S. housing market, government-sponsored enterprises. They had this weird dual mission.
Support the mortgage market, make housing affordable, but also make profits for shareholders.
Exactly. And they became enormous, buying mortgages, packaging them into their own MBS, trillions of dollars worth. They definitely became too big to fail.
Did government policy push them towards riskier loans? I remember hearing about affordable housing goals.
Yes, HUD set goals for them to buy mortgages for lower-income borrowers or in underserved areas. This did put pressure on them to buy loans that might have been riskier, and even to buy MBS created by other companies, not just their own securitizations.
Was that the main reason they took on more risk, though?
That's debated in the sources. Some executives said no, it wasn't the primary driver. They argued their own push for market share and profits was bigger. But the evidence does suggest they stretched, especially in 2006 and 2007, to meet those higher HUD goals.
So a mix of factors, probably. Policy pressure and profit motive.
Seems likely. And they weren't just passively meeting goals. They actively developed programs to get into riskier areas like Alt-A and even some subprime lending.
Is there history here? Did they try risky stuff before?
Yeah, the sources mention a Fannie Mae program from the 90s, the Community Homebuyer Program. It had a 97% loan-to-value ratio, only 3% down.
And how did that work out?
It showed significant delinquency rates later on. A potential warning sign, perhaps?
And you mentioned they sometimes bought loans just temporarily.
Yeah.
To meet goals.
Yes, engaging in transactions apparently designed to hold certain goal-qualifying loans right around the year-end reporting date to boost their numbers. Kind of like gaming the system a bit.
Okay, so we've got the bubble, the bad loans, the complex securities, the rating agency failures, the regulatory gaps, the incentives, the GSEs. It feels like a perfect storm brewing.
It really was. And by 2007, the storm breaks. Mortgage delinquencies and defaults start rising sharply.
And those AAA ratings start to crumble.
Fast. Remember that stat. In the first 10 months of 2007, 92% of the MBS deals issued just the year before, in 2006, had at least one part downgraded or put on watch by Moody's. 92%.
Investors must have panicked.
They did. Prices for these securities just plummeted. Hedge funds holding them got hit with margin calls.
Lenders demanding more cash to cover potential losses.
Which forced the funds to sell assets into a falling market, making things worse. Some just collapsed. Banks started admitting huge losses, writing down the value of these assets by tens of billions.
And the markets for creating new securities seized up.
Pretty much ground to a halt in summer and fall 2007, and got even worse in 2008. Not just for mortgages, but for securities backed by commercial real estate, auto loans, credit cards. The whole securitization machine jammed.
And the leverage we talked about.
Yeah.
That made everyone vulnerable.
Incredibly vulnerable. Investment banks with 40-to-1 leverage, Fannie and Freddie at 75-to-1. They had almost no capital cushion to absorb these kinds of losses.
Were they hiding some of this leverage?
The sources mention window dressing, temporary maneuvers to make leverage look lower on reporting dates, and using off-balance sheet vehicles to keep debt hidden.
We also saw big banks getting stuck with stuff they couldn't sell, right?
Yeah, Citi, Merrill Lynch, UBS, they created these huge CDOs planning to sell off all the pieces. But when the market dried up, they got stuck holding massive amounts of the supposedly safest super senior tranches, which turned out not to be safe at all.
Because nobody knew what anything was really worth anymore.
Exactly. Total lack of transparency. Trading just stopped. You couldn't price these things.
Then came the liquidity crises. Bear Stearns.
Right. They couldn't fund themselves day to day. The Fed had to step in with an emergency loan, brokering a sale to JP Morgan in March 2008. That was a huge wake-up call.
And the problem spread. Even to firms not directly in mortgages.
Yes, contagion. Because the system was so interconnected, the commercial paper market, where companies get short-term funding, froze up. The repo market, vital for banks lending to each other overnight, seized. Suddenly, perfectly healthy firms couldn't get funding because everyone was scared of everyone else.
Trust just evaporated.
Completely. And the right things kept coming. Billions upon billions at Bank of America, Morgan Stanley, JP Morgan, Bear. Merrill Lynch had over $30 billion in CDO exposure alone by mid-2007. Citigroup's mortgage-related losses hit maybe $58 billion by the end of '08.
And AIG, the insurance giant.
They were deeply entangled through credit default swaps, those insurance-like bets on mortgage securities. As the securities lost value, AIG owed massive amounts of collateral to counterparties like Goldman Sachs. They were facing demands they couldn't possibly meet.
Did the Fed's emergency lending help initially? The discount window?
Not as much as hoped. There was a stigma. Banks were reluctant to be seen borrowing from the Fed, fearing it would signal weakness.
So Bear Stearns gets bought in March '08. What else is happening? That derivatives market Greenspan championed.
By mid-2008, the OTC derivatives market was estimated at $673 trillion notional value, mostly unregulated and highly concentrated in the biggest banks. JP Morgan held $94.5 trillion, Bank of America $37.7 trillion. Just immense potential risk.
And more banks were getting into trouble.
The FDIC's problem list was growing steadily. Then came September 2008.
The pivotal month. What happened?
It was just one body blow after another. Early September, the government takes control of Fannie Mae and Freddie Mac, putting them into conservatorship.
Acknowledging they couldn't survive on their own.
Then, mid-September, Lehman Brothers, a major investment bank, files for bankruptcy. The government decided not to bail them out.
And that caused chaos, right? Especially in money market funds.
Absolute chaos. A major money market fund broke the buck. Its shares fell below $1 because of losses on Lehman debt. That triggered a run on money market funds, a core part of the financial plumbing. The system shuddered.
And AIG.
The very next day, basically, the government had to step in with a massive $85 billion bailout for AIG to prevent a complete meltdown. They were deemed too interconnected to fail, unlike Lehman.
So the government did intervene massively, just selectively.
Yes, and they rolled out new lending programs, the PDCF, the TSLF, trying desperately to pump liquidity back into the frozen markets.
But the damage was done. Panic set in.
Full-blown panic. Credit markets seized completely. Businesses couldn't borrow. Trading stopped. The stock market plunged. Nobody trusted anyone. Nobody knew who was exposed to what. Total lack of transparency.
And the real-world consequences. Devastating.
Absolutely devastating. Millions facing foreclosure, families losing homes, savings wiped out, huge damage to communities, schools losing funding, local services cut, state budgets blown apart.
And the recovery has been long and slow.
Very long. Foreclosure rates stayed incredibly high for years. In many cities, distressed sales foreclosures or short sales became the majority of home sales for a while.
And this wasn't just a U.S. problem, was it?
No, it went global fast. Because of that interconnectedness, house prices fell sharply in the UK, Ireland, Spain, many other places that had their own bubbles or were tied into the global financial system.
Okay, so let's try to pull this together. We had a housing bubble fueled by really loose, frankly irresponsible lending.
Which was then amplified massively by complex securitization, MBS, CDOs that nobody fully understood or could properly price.
With rating agencies giving faulty safety ratings, driven partly by flawed models and conflicts of interest.
Layered on top of a deregulated environment where oversight didn't keep pace and Wall Street leverage soared.
Plus skewed compensation incentives rewarding short-term risk and the complicated role of Fannie and Freddie.
It all culminated in those cascading failures, the market freeze up, the bailouts, the bankruptcies. A truly global crisis.
Looking back, what stands out most to you? Any aha moments from digging into this?
For me, it's still that number, 45,000 AAA ratings for mortgage securities versus 6 for companies. It just crystallizes the breakdown in risk assessment and also just how fast a problem in one corner U.S. subprime mortgages could metastasize and threaten the entire global system because of that interconnectedness and opacity.
Yeah, the speed and scale are mind-boggling. Okay, final thought for you, listening in. We've walked through all these complex factors, the lending, the securities, the ratings, the regulation, the incentives. If you had to pick one single lesson from all of this, what do you think is the most critical thing we need to remember to prevent this kind of crisis from happening again? And maybe more importantly, what should actually be done based on that lesson? Something to really chew on.